Hi everyone, welcome to our monthly update. The performance of the fund in November was minus 1%. The majority of the loss was caused by our long position in Dish convertible bonds. The Dish stocks sold aggressively in the month of November after the company announced minor delays on the beta testing of the new network in Las Vegas at the Q3 conference call. We believe the sell-off is highly unjustified. We think the new network that Dish is building has the potential to disrupt the US telecom market, both in terms of pricing and capabilities, both for retail and enterprise customers. The company actually managed to issue 5 billion bonds in the month at the peak of the credit market, and that decreases substantially the risk of a further equity or convertible issuance to fund additional investments in spectrum and for the construction of the network. So we remain very positive on the stock. We heard very good feedback from both Dish and Amazon executives on the Open RAN architecture at the AWS conference in Las Vegas in the first week of December. So we remain very constructive and very positive on the story. We think the Dish stock return could be potentially in the triple digits in the next 12 months. So we actually added at the low on our position on convertible bonds, and we remain long, and this is one of our top conviction in the book. The rest of the negative performance can be explained by a small mismatch between our longs and our edges. We were forced to take some stop loss on outright shorts in the first half of the month, given the market squeezed aggressively. We remained edged mostly via puts and CDS while we closed some of the outright exposure. So we actually lost some money when the market corrected in the second half of the month due to a resurgence of the COVID variant risk and the surprising hawkish reaction of the Fed to the Omicron variant news. We reshuffled the portfolio based on those news. We added edges, especially on via equity market puts on equity indexes, and some CDS exposure, especially short on Turkey CDS. We think the combination of uncertainty regarding the growth outlook caused by the Omicron variant, plus some uncertainty on the Chinese outlook caused by some ups and downs on the local real estate market, in combination with a potentially hawkish Fed going forward, given the very high level of inflation that we currently see in US, both in terms of CPI but also salaries, is very negative, as a potentially a very negative combination for risk markets. So we remain we keep a very high level of hedging in the book, especially via puts and CDS, while we stay long, especially seats where we think we have catalyst in the next 2 or 3 months that can be potentially uncorrelated with COVID events and monetary policy developments. That's it for this month, and see you next month.